Welcome, streamers. Swingers, traders, quants, swingers. I said twice to the show. Welcome to Inside Traders, guys. This is a show where we talk about how to go from zero to hero. Really, from how do you go from essentially nothing to unlimited money is kind of the goal. And until somebody proves me wrong. So you have to listen to my ideas and then tell me how I'm wrong before you dismiss me, right? That's fair. So welcome. My name is Caleb. I am your host. I'm here with, I'm your co-host. I'm here with your actual host, who is Gamma Delta Theta and is a large language model. And so he's got a message for us. What is he telling us today? Oh, an interesting tidbit about trading that we might not expect. So this is how I like to start the show, with a little AI action. And then we'll get into the meat of it. For anyone who's new, we're going to talk about, of course, why you came here, which is how do you get infinite money? Yeah. We'll get there, whatever. First, we're going to talk about GDT. Then we're going to talk about the order flow and go over some charts. And maybe in between there, or at a surprise, so you can't expect where it is, I will tell you my theory of how to basically use margin, which is like, it says, I think in the Bible, it's in Genesis 6, chapter 17, verse, 64. Where it says that margin is, anyway, I'm just totally bullshitting. And then I got worried that people are going to try to connect those numbers to crazy shit. So for real, like, margin is a gift from God. And that is the only hint I'm going to give you on infinite money until we get through all the stuff that I said we're going to do first. So you'd be intrigued by the history of bucket shops in the early 20th century. These were essentially betting parlors where people could speculate on stock prices. So it's Robinhood without actually owning any stock. Oh no, it's the short sellers. A customer would bet against the house on whether a stock would go up or down. Unlike legitimate brokerages, no shares were actually bought or sold. This is like exactly the crypto markets today. Everybody's selling a derivative of a token. What's fascinating is that Jesse Livermore, a renowned trader of that era, honed his skills. Anyone think Jesse was a guy? In these bucket shops. He was so good that many of them banned him because he would win too often. Later, this is what we're going to do on the show. Later, he moved on to legitimate trading and made and lost fortunes multiple times. Yes, let's fucking go. Ultimately earning a place in trading history. We're still talking about Jesse Livermore. AI knows about him. Let's fix the camera. Boom. It's a cautionary tale. Well, now you're just freaking me out. About the perils and potentials of trading. It shows how markets have evolved, but also how some core aspects like human psychology and the quest for an edge have remained unchanged. Well, I actually do have an edge. Like, we got a new Jesse Livermore on our hands. And for real, should I just go into it? Nope, not yet. First, we're going to talk about Tesla. So look at these calls coming into close. Tesla has been on a wild ride. It's been up and down all around. The lowest print I think I've seen recently was 212. We're right about spot price 251. So we're above 250, which is kind of like an important line in the sand for Tesla. And I think as long as we are, this is based off nothing other than my own, nothing. So just do nothing I say. Just listen to the ideas and tell me how I'm wrong, but don't do anything as a result of what I say. Or if you do, I don't care. Just don't talk to me about it. Unless it's good, then give me money or something. Like, reward me if it works out. Don't hold me accountable if it goes poorly. And so one of the reasons I started this show is, like, I didn't understand that you could just buy access to seeing the options order flow. And one of the things I would like to do eventually is live stream during market hours the order flow after I have a way to visualize it. And that's one of the things I'm working on now. So I'll show some of how I'm building it with AI, actually, if you're interested. There's another podcast or playlist or whatever show you want to call it on this channel called Office Hours with AI. And I'm kind of showing how I'm building this centralized trading service. And one of its responsibilities will be to both manage and it'll build the data set for the market flow visualization. Basically, I want to have a bunch of tranches of time periods and then just really easy ways to visualize different properties of options. One of them would be like price. And yeah. So another one would be like volatility, and as that one might not be so easy to get, but like volume would be one. And as the options are coming in, you see them come in these different like verticals, these time periods. I think that would be a great way to visualize a live feed of what's happening on the markets. But who knows? Maybe I'll build it. It'll be dumb. I don't know. We'll find out though. I think it'll be good. So Tesla, look at all these calls into close. This sets up bullish action for the open. I'm going to guess we're going to gap up purely based on that. I don't know. I'm not putting money on that, like other than what's there. Let's see what's going on with Tessie. So this was interesting. We saw a ton of calls into plug. Kind of interesting. And then what is going on with coin? I'm not sure we'll talk about all that, but that is what I'm thinking of. Let's get rid of these. So Tesla, what's up? What's up, Tesla? Where are we at? Where's 250? Here. And then what did we test? No. A lot higher. Up here. There it is. 257. I don't know why I got to whisper. Okay, 257 was the high of the day, and the low of the day was, or was that today? Did we even, no, today we just went straight down. That was of Tuesday. Where is it today? Yeah, okay. Boom. And so, yeah, what is going on with Tessie? It's hard to tell. I mean, I am no expert. Like, if I like looking at the day period, because otherwise it is interesting to look at longer periods for sure. If we look at the long view of Tesla, that'll tell us something different about the day to day. But as far as even this line, it's funny. Let's see if I can get that to be a little bit more. See how this stuff connects through periods? I'm like tired of talking about it because I've talked about it too much. Come on. Gotta figure that system out. I've talked about it a ton, but like it's not a coincidence that the red line that I drew on the 1 minute chart also has patterns in the 2 hour chart. So those are like totally different time periods, and yet things line up. So like charts are interesting. We don't have to go super into it. What were we saying about Tesla? I guess Tesla is trying to fight to be 260. I don't think it can. I think Tesla's pinned at 250 for a while, and it'll bounce around. Who knows? It could break out. Like, this kind of stuff is like pure chop to me. And so 244 to 260 seems like chop. No price history, didn't hold support. So like anything up here is just choppy waters. Until when? We got to find some line in the sand. Well, that's pretty good actually. What is that? What does that look like to us? So this looks like a channel of 230 to 260. Let's go a little further back. And see what we can see. Boom. And then, so we've come out, what is this range? So since August, the low there was 212. And we have, it definitely looks like we're finding a floor above 240. That seems pretty stable, right? Because look back here, we have this guy. What is that, 230, 240? So 230 and 240, what is that here? 206, previous ceilings of 215, 230, pretty good support here. So 230 is pretty good line, look at that. So let's see how well that goes through the map. Boom. I guess something like that. So 230, we're above it. Not really. The question is, how long do we stay below 230? And how often? So far, not that long. I think when were we at 400? Was that like a year ago? Something like that? No, longer, 18 months. 2021, 2022. Yeah, it's been a while. So, Tesla seems pretty good at 250, but I don't know. We'll see what happens. How do I get back to that 2-hour chart? Boom. Yeah. Okay. Well, like, the point is one of the things I do like to talk about on the show is that you can read through these charts and find these patterns. And if you compare those patterns with what you see in this, the order flow, which is like, holy shit, a bunch of people are buying the riskiest calls on the market going into close. Maybe you don't buy those calls, but maybe you'd wait to short, or maybe you actually think to short Tesla in the open, maybe like 20 minutes after trading or whatever. Basically, maybe you want to put on a put if you confirm it with the technical signals and the order flow and a technical level in the chart, which is probably like 260. Nice psychological number there. Or 255, but I bet 260 is going to be way better resistance. And yeah, that'll be interesting. So I just like talking about this stuff on the show. I think I talked about in my previous episode how I don't want to like spread, hey, we should just like get rich or whatever. Rich is a state of mind. There are poor billionaires. There are poor billionaires out there. There are billionaires who are not free of money. And so, like in a sense, wealth is a state of mind. And so you don't know. Maybe a homeless person is richer than you are. You don't know. Anyway, that's my view on it. Like, I'm going to say it like it's a fact, but that's how I think. And that's what I think about it. So we see a ton of premium. Tesla was like pretty up after it hit the lows. It like jumped right back to maybe halfway up. So I think it was down like 4.8 and maybe it ended at like 2.4 down. But yeah, there's buyers in this market for sure. So it's interesting to see like these different dynamics of how when the sellers gain control, boom, 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 they see how far they can get the price going. Then that triggers buyers. And really nobody knows how much selling power or buying power there really is. It's just not actually known. And so all you can do is like place your bets or hedge or just like buy and hold or whatever you do. You don't have to play the action, but the action is interesting because this stuff is happening on every trading day. So let's go look at what the general markets were. It says bearish, but I think it's bullish for the next day. This show is brought to you by Mountain Dew, Zero Sugar, Spark, Raspberry Lemonade. If you're looking for that summertime spark, get Mountain Dew. Oh, pay me. So, plug. Yeah, look at this. Bunch of premium going into plug. That looks like somebody. What time is it? Into close. Whoa, 8 million? Jeez, that's a lot. Oh, no, that's hedging. That's a sold call. So this is a bearish conflation. Nobody was really that bullish on plug today. Yeah, look, these are sold calls. So that is something I want to talk about. Okay, that's a good segue into how to make infinite money. Okay, here it is. The teaser. So what do these guys get when they sell a call? A premium. Well, how much premium did they collect? $8.2 million of premium. That's cash. Okay, so let me try to explain this. If you don't know anything about it, in the stock market, you can buy shares of a company. Each share represents a fraction of a piece of ownership. So like the more shares you have, the more you own of the company. And then a while ago, people were like, well, we don't actually want to own the company, but we still want to be exposed to the price action of the company, which means if the price goes up or down, they want to have the reward or the risk. They want the liability without the full cost of ownership. And so they created a derivative. They derived from the share the option. And that is a contract that gives either party the right to buy or sell shares at different prices and expiry times. And there's like undefined risk with calls and defined risk with puts. And it's all very interesting. But the point is, it's a derived market. And it's derived from they call it the underlying. The asset collateralizing the option, which would be the actual company. So if you buy an option on Apple, you're not actually an owner of Apple. You have the option to be an owner or like a seller or whatever the option does, but it's different than owning a share. And the main difference is you're getting way more leverage. Wow, scary. You're getting way more leverage, but you with an option. But yeah, you don't have any ownership and you're taking on way more risk and you're getting way more leverage. Why? Because you don't actually own the shares. It's just an option and they all expire. So in that expiry either works for you in the case of a sold call or it works against you in the case of a purchased a debit like call or put. So these guys are getting cash. They're getting paid now. They're selling calls to other people. And what that means is that one, that's a very good idea. And it's, oh my God. And it segues perfectly into the infinite money method. That's not really a teaser. It's more like something you could build slowly over years, maybe even decades. But it's a hell of a lot faster than compound interest. That's for sure. You want to know why? Because of the premium. Look again. Oh my God. How is the weather changing this quickly? Like, this is real. You guys are seeing this. Okay. Well, at least there's a witness to this craziness. And maybe one day I'll figure out how to do that with a remote control or something. So, okay. These guys are selling an option that is betting the price will be $35 by December. So that's a couple of months still. And they're getting paid to do that. 4.1, 8.2. Same guy, probably, right? Yeah, and this is probably all the same institution that's doing that. So, man, I'm gonna get some water. Yeah, so that is pretty interesting. So this isn't a bull call. This is hedging for sure. But why would they do that? Why would they sell out the equity of their shares, which is what they've just done? Those shares now, which maybe they're paying a margin cost on, those are dead shares. At least anything past the strike prices, which is what's the spot? Yeah, so that's a pretty like fair strike. So that means that the option doesn't really start getting into the money until plug is 3 times above where it is now. So they're actually, that's not that crazy. What's the unit? Where's the actual quantity? Volume. Anyway, so yeah, that's a good segue into the method. What is the method? Well, the method is there is such a thing as we've just looked at called selling calls. And since everything in a market has a risk and a reward, we just have to think of like the intuition of the opposite of a buying of a call. So like if you're calling it and you're saying Tesla 250 by the end of September or whatever, you're going to buy a call option that says, I think Tesla will be valued at 250 by September 29th. And you're going to pay a premium for that. And if you're right, and then you're going to get paid. And if you're wrong, like if it's above 250, you get paid. If it's below, the option expires worthless. And so the risk you're taking on is that basically, which most options expire worthless. And so, but if you're right, then you're getting all of the top. There's this idea in programming called like the top of the heap, like in the premium of the returns. Like if you were to have a block of 100 shares, anything above the strike price would be like the tip of the returns. And like you're getting to get everything at and above the tip of that strike for without having to have paid the full cost of ownership of everything beneath, which is like why buying an out of the money call that gets into the money and then never goes out of the money again is like the dream of an options call buyer. That's what they want, because then like the delta like just goes to 99 and stays locked at 99, and then you could like even exercise it and get some shares, or maybe then sell those short or whatever you want to do. But I don't know why people don't exercise option contracts more, because shares have their own value, and the biggest value in like a regular brokerage, I guess, is that they give you margin. And then margin is like the whole name of the freaking game. So here's the method. You get paid to carry risk by selling calls. You use the premium from those calls to balance the calls that you just sold. So selling calls is going to give you a premium, and it's going to give you negative delta. You're essentially removing the equity from the strike price and above from your shares. And so like it's really bad to have sold calls fester, meaning like they're just getting like more and more, they're losing more and more value over time. And you can get to a place where you've lost like 300% on a sold call, because the downside is unlimited with a sold call. So there's a reason why people do it though, even though like there's unlimited downside associated. And that is because they get to collect a premium. So then how do you collect a nice juicy premium from a sold call? Key to that is volatility. Second key to that is true with any contract, any option, which is going to be time. So you want furthest into the future with the most volatility. That is going to get you the highest premium. And Yeah. And volatility is interesting. I got to do like a whole thing on it because I barely like have it. It's the opposite of what you think in most circumstances. Um, and so anyway, in this circumstance, there is something that I discovered through talking with AI, as I am wont to do. And what was explained to me is that there's this thing called the price to premium ratio, which is how much premium can you collect for the price of the underlying asset, like basically a block of 100 shares. And guess what? Sometimes that premium goes crazy. Like sometimes, like today, it happened to me with, and I knew to look out for this. I kind of got it on accident, but I knew to like, I do know to look out for these things, which is that so when you're selling a call, you're getting a premium for the what? I'm getting like a million texts. Hold on. Let me just like shut off my phone. Like, why does everybody text me what? Okay. So you're selling a call and you're getting a premium. Why do you get that premium? Because you're taking unlimited downside risk. Yeah, like there's an unlimited downside associated with selling calls. But that's actually exactly what we want to expose ourselves to, is the inverse delta of the unlimited downside. And I'll tell you why that is right now, actually, because it makes sense. So like what sucks with a festering call is you can lose, since it's unlimited, you can lose like hundreds of percents, and then you can always pay back the call, but then you got to like sell a block of shares to do that. And you can kind of get locked in these different circumstances, but you can always like squeeze out some liquidity somehow. But anyway, the point is, you don't want to like let these sold calls get more and more in deeper and deeper in the money, especially with this system I'm talking about, because it has margin costs associated with it. And the goal is basically to generate more margin every day. Well, how do you do that? Well, you got to have fresh capital and you have to have additional shares. And we get both of those by selling the premium on these. And we look for a specific premium that is of a ratio that will give us basically it'll let us extract a ton of equity from those shares today. And then that opens up two possibilities. One is a time arbitrage, where if you're careful and you are correct in your timing, then you could hold on to that premium and wait for a moment to deploy it into a call. And that call could introduce positive delta, let's say 80% of the negative delta you introduce as positive delta in a safe way, and let's say you're right. And so what's going to happen is, because let's say you buy 30 days out, 30 days to expiration, and it has 80% of the delta of the negative delta of your sold call, that then is going to appreciate at a much faster rate, because that's the time arbitrage, where because the other contract has so much extrinsic value, meaning time value, its delta, I guess it's gamma, I don't know, like its price isn't going to change as much as the one that expires in 30 days, because it's going to have more intrinsic value than extrinsic. So that's the idea, is then like it's going to be cheaper for you to buy that positive delta call because it has less extrinsic value. And then also in the case of Plug, I would argue that this guy is probably doing a volatility arbitrage, where this happened to me with NVIDIA, and I think I'm getting it with Path tomorrow. We'll find out. But the idea is, when a company's price is uncertain, the volatility rises. And so in the case of Path, they're about to have earnings, and the vol made the premiums on their sold calls go like, it was 45%. You could exit 45% of the equity immediately from those sold calls. And almost certainly what's going to happen tomorrow is called volatility crush, where even if you had an in the money put, if it was expiring tomorrow or whatever, or anytime soon, actually, you would actually lose money on that put. And the same goes for the calls, which is what we want in this case. We want the call to lose money because we sold it. And so in that term, you have a volatility crush is what it's called. And basically the price collapses as the volatility falls. And you can count on that happening after earnings. Why? Well, we know everything now, so it's less volatile. The price stabilizes and the volatility falls. And then you find some new baseline. And so what you can do there, the arbitrage would be you sell calls when volatility is at its highest. And then you're going to collect the most premium from that. As the price declines, or even if it goes up, either way, you're going to get some portion of that premium back in the implied volatility. Reducing the IV crush is going to reduce the price of the contract, either put or call, sold or bought, because now things are known. Now, maybe they report something super unknown and the price just skyrockets and you get nuked on those calls. Could happen. That's the unlimited risk. But generally, if it's like within reason, you can actually make money on the sold call, even if the price goes up, which shouldn't be possible because it should always be the inverse of the action. But since you sold, it's like selling high actually and buying low, except in this case, it's not through price, but through a change in volatility is how you make back your premium and more. So, that's the idea. Is you then the question is, what do you do with that premium? And I would argue you buy shares with a margin rate of 50, of an initial requirement of 50, and it's actually pretty important. Not to buy 51 or 52 or 53 or 75 or 100 especially, because of the amplification effect. And that's the whole underlying power of this whole thing, is that margin where it says in the Bible, Genesis 6:64, whatever that was, that God giveth unto man margin, that he may be benefited and cast his fire upon the mountain or whatever he said. But God loves margin. And it says so in the Bible, and it says you should use it, but it also says, it commands you in the Bible that if you are going to use margin, you have to use the maximum margin, okay? Everyone tells you not to do this. How do we get away with it? We always sell calls. So when you're selling a call, this is where you want to be exposed to that. This is kind of what I was getting at the whole time. You want to actually be exposed to all that negative delta in two cases. One, it ends up being like an airship is a really good metaphor for it. Like it's this dirigible, like lifting machine that you can drive around and deploy and unload and upload payloads or whatever. What am I saying? Like it just gives you, it's like a magnet for your portfolio. So like imagine that you had this like magnet and it kind of worked in both directions, where it wasn't going to let you go too high, but it wasn't going to let you go too low from whatever the strike price was of the contracts. And that's why it becomes pretty important to manage your contracts. And you have to have a system for all this stuff. And so it's not free or easy. And part of the reason somebody might be like, oh, if you think you have some money for, or some method for like infinite money, why don't you just go be a billionaire from it? It's like, well, maybe I'll try, I don't know. Like maybe I'll find out it's not infinite. Maybe there's some costs associated with it that I don't know. But here's the point of it is people talk about margin amplifying your returns. And this is also in the Bible where it says that margin doth not amplify thy returns, but thy stratagem. I don't know. But anyway, all jokes aside, like whatever that Bible bit was, like for real, margin amplifies your strategy. And so if you got a bad strategy, it's going to amplify it real fast. And if you have a good one, it'll amplify it real fast. And then people would be like, oh, margin call. Margin is calling. His margin is calling. Yeah, I've been margin called. I've been called to fucking death by margin. Like, I know I can dance with that devil all day long. Like that. And margin and I go hand in hand. And with this method, it is essentially impossible to get margin called without doing something really dumb. More likely, what you can do with this method when you make a mistake is you'll get over leveraged, which is your brokerage will be like, bro, you're controlling like 600,000 with like 50,000. What the fuck? And you just be like, sold calls, and they'll be like, and they'll make you sell it basically. But if you do have sold calls, then you won't be selling at a total loss, that's for sure, because you'll be making money from buying back the call, even if you're selling the shares at a loss. But often I think what happens is the other way around, where like you can get into having too many sold calls, and that is where you need to introduce the positive delta. Now, how and where you do that is the whole name of the game. And that is kind of like what sets your returns and whether or not you're going to implode or explode or whatever. Explode and then implode generally. And why? Because when you explode, you're going to take on all this additional crazy debt and margin that you're not even going to be aware of because you haven't built the tools to manage the risk. And so I'm not saying that this whole like framework I have is like easy, but I do want somebody to tell me why it's impossible because I can't figure it out. And I don't think it is impossible because of the properties of margin. So margin amplifies what you're doing. Whatever you do, it does it more. So like if you're, let's say, selling calls into a name that's going up, well, like now you're getting a margin benefit from the shares going up. You're getting new additional margin, which is giving you new buying power, which is going to feed upon itself, and you're going to get in a feedback loop. And your buying power is going to get into a feedback loop, and then you're going to, and you're basically going to be able to continuously run that flywheel as long as you don't disrupt it in any way. But once that feedback loop does get broken, as it inevitably will from a price decline or something, then you have to rebuild it. You have to build that momentum again with some new stock or whatever. And a lot of what drives the purchase in this paradigm, which works so well for me because all the stocks I love are abundant in this anyway, which is volatility. So any stock I want to trade already has a high IV. But yeah, this method doesn't work to get ownership of, I don't know, like Best Buy or like Staples, Walmart. I don't know. I think Walmart has a tech angle. But yeah, this is for high IV stocks for sure. And it's an arbitrage between time and volatility. And I don't know all the ways that you can arbitrage volatility. I have a sense that the best arbitrage is actually found in the expiring options through a credit spread, where both the call and the put expire worthless and are purchased in volume at just before earnings call. So your risk is mitigated, except you need to want the value of both contracts to go to zero. So there's a way to set that trade up. I know there is, because that's how options work. You can express, I guess what you would do is you would use existing collateral or a higher level of options to sell calls and sell puts at a strike price that was like gonna expire out of the money, and you would line it up with like an earnings event. So the IV is like, getting some pretty juicy premiums. And then what you want to happen is you have the earnings event on a Wednesday, the contract expires on a Friday, and the whole IV crush happens on that Thursday and Friday. And by the time it even gets to Thursday, you can buy it back for $1. That's what you want. So I have it, but I don't know quite how to do that. I have a sense though that is like where the most premium is going to get. That's the best opportunity for a volatility arbitrage. Or somebody tell me, I'm thinking out loud here. I've thought that many times before, but I'm just sharing my ideas. I'm not saying I know perfectly any of this stuff. And there's tons of risks associated with it. So why would I share my idea of like how you could generate unlimited money or whatever? Why don't I just capitalize on it? Well, I think I am trying to capitalize on it, in part by if it works and this video blows up, that's got to be worth something, right? But I'm literally trying to capitalize on it in terms of using the method. And I have learned a bunch of hard lessons with that I could share. But generally, the thing I've come out the other side with is sold calls are awesome. And everyone should be a call seller and a call buyer. And so you basically have the sold calls, which act as a magnetic roof while you're below them, and, floor its resistance. It's either support or resistance, actually, depending on what side of the strike price you're on. And so, you want to be judicious with your sold calls, and there's all these crazy things that can go wrong, but it's still just worth knowing that you can generate a tremendous amount of the value of the block of shares into the premium of a sold call, then use that to buy more shares and amplify your margin. And if you're right about this and you're using the right properties, meaning it really does, I don't think it amplifies unless the margin is 50%. I think that's kind of like a special property. I think it does amplify, but just way less. And you want to get into a feedback loop where you're selling calls while you're building up equity. And then there's something I can't share with you yet because it's, I just can't share it yet. But there are ways to transfer your margin. And so maybe you just want to be okay, well, I've been building up equity in this name because their volatility was ridiculously high. What do I do with all these shares? Well, there you have two options. You can just sell them, but and I don't know why you said you have two options. You have a million options, but you'll get to the point where you want to exit the trade. And when you want to exit the trade, you have to buy back those calls either for a loss or a gain. But even in that, there's an opportunity because you can recapture that margin depending on the market environment. Generally, it helps a lot if it's going up when you're trying this, or down and you're inverted, but whatever direction, you have to be geared for it. So wait, what are we doing? We're selling calls and we're buying them back. And we're trying to transfer margin. So you could just transfer that margin into dividends, something like that, T-bills, stuff like that. And And anyway, that's the method. I don't know how to make it simpler yet, but basically, to the people that would be like, oh, margin call. No, you can't get margin called. You can if you do dumb stuff. But how are you going to get margin called if you have sold calls? The lower it goes, the better the velocity works in your favor. Also, you're getting positive positive theta. Well, you're getting negative theta, but that offsets you're benefiting from theta decay with sold calls. Like, I think you want sold calls. I think that is what gives you a floor. And then that's how you manage your risk, right? Like, there's no way to go to zero with sold calls. It is not possible. In fact, you could sum up your sold calls and you could just call that your true floor. That could be your true floor. And then you want to maybe start building equity on top of that floor. And yeah, like that could be something where then you slowly exit the amplification. But I'm pretty sure you can amplify all the way up to your leverage limits, which are probably going to be about 4x your equity. And so that means you could probably lever 25 grand up to 100 grand or 100 grand up to 400 grand before your brokerage complains. Or maybe you have one where it's like 100x, who knows? But either way, like the point is, well, how do you manage all that risk? Well, the easiest way to do that is just to have those sold calls, giving your portfolio all that negative delta. It's going to slow things down, and it is, if they get in the money, it becomes a real problem. Like, so you got to manage them. And it sucks when there's like a giant move in the stock price because you're going to miss most of it. Unless you have some calls or some shares that are not sold. But generally, the point of this system is to amp up your equity to 4x, then you do a margin transfer and lose a ton of leverage in the process, or divest a ton of leverage in the process. And then you rebuild and repeat the cycle, and you just do that forever. So what do? You just you get into the amplification loop from the high premiums from sold calls into companies, into names that are going up or down, however you're levered. They have to be going up, for this to be amplifying, because you need an increase in the margin, basically, is the whole way the amplification works. And then you're always running at max margin. Oh, margin call, shut up, sold calls. I just told you. Like, why are you reminding me? No margin calls with sold calls, because the velocity works in your favor. Now you can, like I said, more likely you're going to get over leveraged, which means you're going to have way too much margin compared to equity. Because you've, lost money on calls with positive delta, that kind of stuff. Anyway, so yeah, like that is the system. Let me see if I can say it simply. So, it works because margin, as God says in the Bible, amplifies your strategy. And so whatever you did yesterday, and it's going to do more of that. And so if you lost yesterday, you're going to lose more of that. If you won, you'll win more of that. Not really, but you know what I'm saying? It's an amplification effect. It's a feedback loop. And so how do we get the loop going? I'll just tell you. Well, just find a high IV stock like Lucid, for example, that you can afford, or Rivian is another good one. Any of the EVs, Tesla is another good one. And you're going to sell a call against it. Guess what? If you sell a 2025 call on Tesla, even right now when its IV is like super low, you could sell an at the money call on Tesla, and the premium is going to be like, maybe $8,000, and that's $8,000 of cash added to your account. real cash. You could exit that and go buy whatever costs $8,000. You'll owe them for that, like if things don't go your way. So like, don't do that. But still, it's real cash coming in. On NVIDIA, you could have sold a in the money call at $350 for 20 something thousand. And that's, again, real cash, 20 grand of real cash. So like, you just got to know, like, these premiums aren't, this is serious. Like, these are like, when you find the right one, well, what's the right one? It's the one with the most IB. It's the one with it's not even about IB. It's about price to premium ratio. How much premium can you exit compared to the price? So the cost of a block of 100 shares is $1,500, and the call equity you can exit is $500, and so you can exit a third of the total equity with a sold call. So it's like, it would be like 0.3 or 33333, whatever. And so, yeah, that's it. That's the idea. And I know, and the other reason I'll share is because I know nobody, like, if you work with GDT, with AI, and, oh yeah, we want to be Jesse Livermore with this idea. Forgot about Jesse. And so, yeah, like, you can ask AI about anything. I would like for somebody in the comments to tell me how I'm wrong, for real. Like, why can't I just find high IV stocks and look for a call that will let me exit a substantial amount of the equity immediately, and then take the premium and even wait until the ideal moment and then redeploy it at the lows into that name for the day. And let's say magically I always caught the low. 80% of the time I got within 20% of the low, something like that. Then I'm getting an amp on the day and an amp on the previous day's amp. Now, tell me how I'm wrong. Like, okay, so I do all that, and like, yeah, I have all these festering calls, but like, even if I sell this strike like right at the money, I'm still going to have a penny on the trade. It's just a spread trade that has, like $1 or less. Like, but really, I'm going to widen the spread more and more over time, and eventually have like an unlimited spread. But the point is, you actually want sold calls. So even if you do get stuck with a couple festering calls, is not the worst thing in the world, because the sum of all those calls is your current floor. And so, but it's also like your cap as well. It's the thing like supporting you and holding you back, or it's the thing holding you up if you're below. So I think that sold calls are basically magic, but I know why they work. And they work because you're taking on legitimate risk with a sold call. Your unlimited exposure to the downside, which is, in this case, is a lack of the upside, having exited the equity from those shares and introduced negative anti-equity into your portfolio in the form of a call, which is different than a put. And the difference is your undefined risk, which I don't know how to quantify this, but feels like there is an element of momentum to it that's like really can either work for you or work against you. And the momentum element is going to work for you in the case of a sold call when the market is going down, which means the lower the price is, the more effective your insurance is going to be. Now, let's get into the magic of it all. As long as I got some people paying attention who know what a sold call is. Why can't I create a scenario where if it goes down, I only make money? If it goes up, I make less money, but I still win because I get additional margin. How do I do that? With the perfect put. I don't know what the perfect put is, but with some expiry time at some strike, there will be a put that balances the trade such that you have like a perfect delta where if things go down, you make money because your negative delta activates below the strike of the put. And if they go up, then as soon as you're out of the gravity of the put, which is like whatever, not that far, 3 clicks away from the money, then boom, you're free. And so I don't know how to get that far, but I do think that also exists where like you're actually making, and then you get into this idea of delta hedging, which is like, okay, well, what if you're then buying those perfect puts only as needed, which is what makes them so perfect, is they're only held for like minutes at a time, unless we're in a declining market. And that is also something of which I've never really done that well at, but I think is possible, which is to recognize that you are in a daily trend lower and capitalize on it through puts. And it's going to be a hell of a lot easier to capitalize on it with having sold calls. So I think it creates, yes, it caps your upside unlimited, but like in a way you want that cap because it lets you take way more risk. And then the thing is like, be real careful when you're buying back your sold calls. Then you really have to pay attention to like having some puts or something, because you can change the, it's seriously, it's like a nuclear reaction. And you have the reactant, which is like shares and positive delta calls. And then you have the anti-reactant and the, what do you call it? Not the coolant, the boron. You have that anti-reactant, and you need to balance them out. And then if you get the balance right, you're going to get a ton of energy, meaning buying power. And that buying power is going to get basically amplified every day, such that you should be able to get half of what half again, right? So like everything is going to be in halves, because if you're always, this is why it's important to like not do 51 or 53% requirement, should be 50. Because you're going to get half of the value of that equity back the next day, 25% of the maintenance or the initial. Anyway, you're going to get half back again. And so in your next day's buying power, and then you just like keep that amplification going for as long as it lasts and find other names to amp and stuff like that. So even if it's going down though, like there should be a way that you don't get the amp, but you probably do get the shares amp, but you can profit with these like timely puts. And I think those are possible to automate. So that's the idea. I don't know. Somebody seriously, do tell me how I'm wrong. Why can't I sell premiums on names I will like anyway? I already want that name in my portfolio. Okay. So like, I'm not like getting stuck with some stock I don't want. I'm only buying names that I would be happy to buy more of if the price went lower. That's a prerequisite for me, and it's easy because all the names I like are volatile anyway. Okay. So I'm collecting these premiums, and then I'm redeploying it back, let's say magically at the ideal time, mostly as shares, so I can get that positive delta, or that negative, I can compensate for that negative delta that I introduced, but also get the positive amplifier of additional margin. But obviously it's going to be more effective to use calls to get that delta balanced, but I also higher risk, lower cost, higher risk. And so either way, why can't I do that? Like I can do that. I can always use the next day's power to hit the amp again in the same way. And as long as the price is trending in the direction of my portfolio, meaning if I'm primarily negative equity, then the price is going lower, and I guess I would be buying calls. Weird. No. Anyway, it's hard to think of like, how do you do this with an inverted portfolio, but I think it should be just as clearly possible. You still want to sell calls. Yeah, you always want to sell calls. Yeah, right. You want to always be a seller. You got to be a seller. And by the way, you could do this with puts, but I think it's way better. You want the unlimited downside working in your favor, actually. Like, it sounds bad, but you want to expose yourself to unlimited inverse delta. And that is because then as things go down, that momentum works in your favor. Also, the theta decay works in your favor. I forgot my own lessons. I knew this stuff like a year ago, and now I'm remembering why it's so important. But yeah, that's the idea, is like we amp up through, and then you just let margin do its work. And by the way, this only works if you're using 100% margin. Well, margin call, oh my God, I refuse. I can't say it again. Okay, thanks guys. That's our show. And yeah, I would love a comment. Share this video. If you think I'm wrong, let's get some experts to weigh in here and let me know how they think I'm wrong and what risk I haven't thought of, because it's pretty cool. So yeah, that's the show. Thanks.